Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, I was just quickly doing a little recap of some things I like to talk about on the show with regard to investing. And this is one of those areas, again, about staying ahead of inflation and, of course, evil taxes. Okay, so one of the things when it comes to inflation is you need to make enough to stay ahead. And again, we talked about the differences between the different inflation tables, and everyday price index, I think, is one of the better ones, where we deal with the things more of what we actually spend our money on versus these longer term things, the everyday stuff. So one of the areas of staying ahead of inflation taxes is how you invest. One of the ways you invest is how you put away money for your retirement, which of course has to do with retirement accounts and that. And we're talking about within 401ks, the kind of choices you have and how we just get to see the returns and not necessarily the standard deviation or the risk that goes along with those returns. And when we're looking, and I mentioned high yield corporate bonds as being one of those things, which has junk bonds in it, which is a very risky play. Another area is these longer duration, where you can get into bonds that are 20 or 30 or anything over 10 is long term. But typically I see 15, 20, 30-year bonds, and it could be 30, 40, 50% of the bond mutual fund invested in these long-term bonds. Well, these are going to be very interest rate sensitive, meaning that as interest rates continue to go up, the stock, rather downward pressure is going to put on the bond prices, so your original investment is going to lose money. All right, so as interest rates start to heat up and we see them increase, that's one of the big dangers and concerns there. And so where bonds might normally give us that negative correlation, meaning that they balance out the volatility against stocks and can help reduce our risk, if they're long-term bonds, that's not going to be the case. If they're junk bonds, that's not going to be the case. So the key is that we want to use what are short to intermediate term bonds as a way to give us that control of volatility in the market. In other words, now when we have a 50-50 portfolio, if we've got the right type of bond funds in there, yes, then we can in fact reduce the risk relative to the market. The next is how we blend together the stocks. That's another way that we can reduce it down. This is all covered in Dr. Eugene Fama. He won a Nobel Prize in 2013. His 3-factor model I covered in my book, 7 Steps to Financial Freedom in Retirement. And speaking of that, here's what we're going to do for the first 10 callers to my office this morning. We got a special offer for you, right? 615-376-5325. That's the number you call. That's the number on your screen. If you would like a free retirement income analysis, which includes an investment analysis, this is where I cover a lot of things I talk about with you personally. Take a look at your current investment plan, your current asset allocation with your company plans, and show you how these things work within your plan and within your particular situation. So in other words, what's the needed rate of return on your money? We determine that. Then we can put together the actual investment plan that's going to help you attain that goal. So a free retirement income analysis includes investments. We're going to talk about Social Security, your overall planning, what you have for income, what you have for expenses, what you have for assets, liabilities, all of that. All you need to do, if you'd like to get this plan at no cost to you, 615-376-5325. Again, I have to limit it to the first 10 callers. Call my office. Tess is standing by to take care of your call. She'll gather your information. She'll send you out a checklist of things to bring to your appointment with me, and we will do up a full comprehensive financial plan for you. And when you come in to see me, I'll give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. This is almost 30 years of my practice. I've developed basically I share stories in there about how I've helped different clients, how the type of planning works. So these are tried and true strategies that I've used over many years to help people do just that. Attain and maintain their standard of living and their quality of life, never have to worry about running out of money, one of the biggest fears we all have, and make sure that you're going to be okay in retirement. And again, this is a personalized plan for your specific situation. So again, be one of those first 10 callers. 615-376-5325. All right. Now, I'm going to share, I covered this now, I'm going to go through a bunch of different things with you this morning. So I'm going to go through this stack of stuff, right, to share with you. This is one that was in Wall Street Journal. Jason Zweig is he's a really great writer, been doing it for a couple of decades, I think, if not 3 decades maybe. In one recent survey, wealthy individuals said they expect their portfolios, you ready for this, to earn a long-run average of 8.5% annually after inflation. Now, how realistic are your expectations? Think of this for a second. 8.5% is what they're expecting to earn after inflation. So that means they're looking at a 10 to 12% annual rate. In fact, as he said, with bonds yielding roughly 2.5%, keep in mind, treasuries are what, about I think a 10-year treasury is somewhere around 2.25 right now. A typical stock and bond portfolio would need stocks to grow at 12.5% annually to hit that overall 8.5% target. Net of fees and inflation, that would require approximately doubling the 7% annual gain that stocks have actually produced over the long term. All right, it's not, this is the problem, and it's not just individuals. All right, now I don't know what your investment, what you're thinking. I know when I ask people how much you want to make on your money, they're like, well, as much as I can. Well, if you lost half of it tomorrow or all of it tomorrow, would you be okay with that? Well, no, I don't want to lose my money. So we narrow it down, because the riskier the asset, or typically the riskier the investment, the greater the potential reward. Not always the case in portfolio design, though. You can be taking a lot more risk and not be getting paid nearly as much as what you could be if you had a different asset allocation. So one of the things we get into is determining, well, what's the needed rate of return? How much do you actually need to make on your money to never run out of money, to be able to maintain your standard of living, quality of life? Throw in some fun money, right? We want to factor that in too. So we start out determining your base. First off, how do we maintain your current standard of living? All right, so we measure that. We do that with what are your expenses? Where do you spend your money? How much do you spend over the course of a year, averaged in monthly, for each month to be able to maintain your current standard of living? Once we have that measure, then we add in inflation. We can see how much you'll need to make on your money to be able to maintain that, because we see, well, there's your expenses, here's your income, here's what you're going to have from Social Security, or maybe you're already getting Social Security. If you have a pension, fewer and fewer people do, but that would be factored in. How much you have saved that's going to be able to provide you income. Do you have any other income sources, like rental properties maybe, or annuities that are going to be bringing in income? All of that we factor in when we're doing up planning. And we determine from that what's the needed rate of return. And we start out low. We want to see, well, what if you had a portfolio that's very conservative, and let's say you're making 4% on a conservative portfolio, maybe only 20 or 25% in stocks as an example. Maybe you're very risk averse and you don't like a lot of volatility. And that might be something we look at to start. And then we look at 5% and 6%. We want to keep it based on what the actual returns are, though. So an example, understanding the S&P 500 index over the last 10 years has averaged about 7.5%, 7.46, I think. So if you look at the S&P 500 index, now that is the 500 largest companies, of course, in the United States. They make up 70% of all the money that's in the stock market. And here's the other kicker, right? Tony Robbins talked about in his book, and they, depending on the period you're looking at, anywhere from 80 to 95% of the time, it's going to that index in fact is going to beat, all right, active managers. In fact, here's a couple of recent articles. This one from Indexes. This is from, I believe, the Wall Street Journal. Yes, Wall Street Journal. Indexes beat stock pickers even over 15 years. Okay, so again, an S&P 500 index fund outperforms the people that are out that actively manage mutual funds. Wall Street Journal again, Wall Street Route. Indexes beat stock pickers 92% of the time. All right, think about that. So that S&P 500 index fund, in other words, is 500 companies that we're just buying it. We're not trying to figure out which one's going to do better than the other. We just buy them all. That's an index fund. You can do it with an index ETF as well, exchange traded fund. What we're looking to do is we want to invest in the market in such a way that we get a broad diversification. We have, and I'm going to talk more about asset allocation, how that fits. Right now we're just narrowly on one asset category, and that's large cap, a blended large cap fund like the S&P 500 index. Very low fees on it. Great way to go here. It's going to have, though, a lot of volatility. And what we now want to do on building up portfolios, we might start with that as one of our core holdings, but we're going to build around that and help reduce that volatility so that we don't have to worry about big drops, being awake at night worrying, is the market going to do this for 1 year, 2 years, 3 years? What's going to happen? How long is it going to take? Is it going to take 5 years, 6 years, 7 years to recover? What am I going to do in the meanwhile? We're not going to do any of that. When I do planning with my clients, this is one of the things we take out of the picture. When you think of it this way, when you have the market as it did in 2000 to 2002, it recovered. Took 5 years to recover after that. That means you were in the market for about 7 or 8 years before you got, you know, from that beginning point to where you started making money again. And then we go through 08 and 09, right? We go through that bear market period. Now you're in the market for like 10 years plus, and you've not made a dime. If you're lucky, you're at break even. And that's if you did as good as the market, right? As good as the S&P 500 index. And what did we just say? Indexes beat stock pickers 92% of the time. That means that most people that had mutual funds or maybe were doing it themselves did even worse if they stayed in the market in that period, if they were, you know, had the discipline to do that. This is why it's so important to understand how these things work and to have an advisor that's on that understands this as well. Because if your advisor is pushing active management, as I just said, indexing is going to beat that. So what are you going to do? Okay, how are you going to, in fact, navigate this in such a way that you're going to be okay? It starts with making sure that you've got the right advisor, of course, right? And we're going to talk about how you can determine that and how you can, in fact, put together these things when you're looking at your 401k as well. But first, we're going to take a break. So join us here. We'll be right back on the Retirement Report.